Hi everyone, my name's Darryl Panes, CEO of As Good as Gold Australia. And once again, this evening I'm joined by my brother Brian and partner at As Good as Gold. And tonight we talk with Alasdair Macleod. Alasdair has been working in the financial world since 1970. Has been a member of the London Stock Exchange for nearly 5 decades. Alasdair is Head of Research for Gold Money and is a very strong advocate for sound money. He's regularly interviewed at King World News, as well as many other premier networks, such as CNBC, and we are proud to announce that just recently, Alasdair has taken on a role as advisor to As Good as Gold Australia, which is fantastic news. So good evening, Alasdair.
Good evening, Darryl. Looking forward to my new role with As Good as Gold.
So are we.
Absolutely.
Alasdair, what we want to do tonight is surprise our viewing audience and talk about silver. No, it really should come as no surprise to them whatsoever. But there's a lot going on. Silver is on the tip of everyone's tongue at the moment. So much so that we have been massively inundated with inquiries about precious metals and silver in particular. And I know just recently that Miles Franklin, of course, I heard was under the same sort of pressure and they were having some issues in delivering silver as efficiently as they normally do. And I know that in our case, it's been the same. And so I just wanted to share something with our viewing audience, Alasdair, before we have a series of questions that we want to focus on with you. Brian and I, as you know, came from a manufacturing background. And for many years, we had X amount of equipment, X amount of staff, and we worked X amount of hours per week. Then we started to develop an export business into Canada and the US. And there was a stage there where all of a sudden, it just exploded. And business doubled and tripled basically overnight. Now, there are only 3 things you can do to accommodate that condition. 1 is to add more staff. 2 is to add more equipment. And 3 is to ask your workforce to put in more hours. We did all 3 of those, but it takes some time. And what I really want to do, the message I want to convey here is that whether it be Miles Franklin, As Good as Gold Australia, it doesn't matter. All bullion dealerships at the moment they're delighted that the interest has increased as dramatically as it has, but they will adapt very, very quickly to that. But lead times have gone out a little bit, and that's to be expected with this phenomenal rush at the moment on physical metals. Keith Newmeyer, just recently at First Majestic, said he believed the retail demand will break the paper and physical markets. Now, it would indicate at the moment, if we keep this up, that that's exactly what's going to happen. But what I'd like to do, we asked John this question just over a week ago, Alasdair, and I've had the question asked of me many times since, and so has Brian, of course, and all of our representatives at As Good as Gold Australia. When people very often look at buying precious metals, they know very little about it and have no idea on the difference between allocated, unallocated, pool allocated, ETFs. To them, it was gold or silver. Could you please provide an explanation here, because it'll save Brian and myself answering 5,000 or 10,000 people, what you read as the difference, what you identify as the difference between those forms of silver in this case. If you could do that, we'd really appreciate it.
Well, shall I start with the weakest, as it were, first? Unallocated. With unallocated silver, you may think you have silver, but actually all you have is, if you like, you're a creditor of whoever is offering the allocated service. You don't own anything at all. you don't even have an entitlement to any silver. You're just a creditor, and the value, if you like, of the provider's debt to you is obviously tied to the silver price. But if they go bust, you go whistle. It's as simple as that. There then two further forms. You've got, I think, what you call pool allocated, and that's the sort of thing which gold money does. And that would be useful, and I think almost the most sensible way to go. If you have a few $1 million worth of silver, you don't want to keep it all in your home. But if you've got lots and lots of silver, then a pool allocated in an LBMA member vault, fully insured and all the rest of it, does make an awful lot of sense. But never, ever, ever go into a pool allocated arrangement with a business that is also doing an unallocated service, because the temptation to mix the two, or from your point of view as someone depositing silver, or having a relationship with a silver provider, the temptation for that provider may be to sort of take the fees and not have the silver, and or maybe rob Peter to pay Paul and all the rest of it. I mean, it's the sort of thing that banks do all the time. I make this accusation only in the knowledge of people that I've known who have gone to collect their gold from, say, banks in Europe, to find that they have a hell of a problem getting the gold out of them. And it's not just banks. I mean, Germany had a hell of a problem getting gold out of the New York Fed. So you can see that this is, when it comes to precious metals, the best thing to do, I think, is really to trust no one. Now, if you're a speculator, then it really doesn't matter. I mean, all you're interested in is the price. So if you're a speculator, that's probably where things like ETFs might come in, because ETFs, again, you have absolutely no entitlement to the underlying silver. All you have is a share in a trust or a fund, as it were, and through that, on liquidation, you will have some claim over the assets of the fund. And hopefully the fund has complied with its prospectus, and if it says it's fully backed by silver, then on liquidation, probably what would happen is that the silver will be sold and money would be passed to you. That's not a claim on silver. So that's, it's one way to get exposure to the silver price, but that is about it. And here I think we must make a distinction between people who invest in silver just the same as they invest in mines or pharmaceutical companies or whatever. It's part of a portfolio. Now, in that sense, you're measuring the performance in fiat currency. So, in Australia, it would be Australian dollars. And you don't actually sort of care. You're not going to be taking delivery or worrying about the security of it beyond counterparty risk, maybe. But that's it. And you're going to be taking profits. You're going to sell it eventually. Now, that's one thing. The other thing is that if you actually believe, as I do, that the global fiat currency system is in acute danger of failure, then the silver that you own, you will look to spend eventually. You won't sell it, because if you think the fiat currencies are going to go, why would you sell it for fiat currencies?
Yes,
you will eventually end up spending it. And that is the key to it. So if you're going to spend it, have you got it? That's a simple question.
Yeah.
And of course, along with pooled accounts, you've got the ability to store physical bars and things like that. Again, you've got to be slightly careful, because one way in which people commonly do this is they have safe deposit boxes. Now, I don't know what the rules are in Australia, but a bank in the UK, if called upon by the authorities, has to let the authorities access your safe deposit boxes. And so you don't actually have control in the worst case, in a worst case situation, over your own assets, even though you think that they are safe in a safe deposit box to which you have a key. So there are all these considerations. And the other thing I would do, I mean, this is not so much for an Australian, because we actually work on sort of the basis of English law, but in America, I mean. In America, it's not just individuals, but corporations have to comply with American law. So if you store it in a LBMA vault, which is owned by an American company, such as I think Brinks is American, then it is certainly possible that the American government will turn around to Brinks and say, right, we want you to submit all the precious metals that you hold for any clients in any of your vaults around the world. Now, under American law, I think Brinks would have to comply. So, there are. I'm sort of broadening what your basic question slightly. I mean, I really would advise anyone, and this is not investment advice. This is advice, security advice. I would advise anyone to think very, very carefully about the relationships of anyone you use to store your gold and silver, and I've been following this debate, which John Adams has been very much taking the run with. And what has come out of this, to my mind, is that there are quite a few operations, and it's alleged, who seem to confuse unallocated with pool allocated. And this is, as I say, for an investor, it probably matters slightly less. I mean, it's completely wrong. Let me put it that way. But, for those of us who are looking at the overall economic situation and trying to protect ourselves through a potential collapse of fiat currencies, it is vital that you know what the status of your silver is, and obviously other precious metals as well.
Yeah. Well, I've always, I'm very much old school. I've always felt, Alasdair, if I didn't have it in my hand, I didn't own it. And I guess it's a little bit like this, and I've thought about this a number of times. Let's say I go into a butcher to purchase, obviously, meat, and I know what the butcher would prefer, an IOU or cash. Now, even though I'm not a great advocate for cash, I know what the butcher would prefer. And so that's the advantage of holding physical metal. I mean, yes, if you've got a reliable, somebody you can absolutely and totally trust as a depository for your precious metals, because you can't hold it at home. And sometimes, let's be honest, I mean, $100,000, $200,000 worth of physical metal at home would be a risk in itself. Either physical metal held at home or in a reliable, trusted, shall we say, depository. I think, and I still firmly believe it. I've been doing that for 30 years. Yeah. Okay. I've got another question for you. Silver and gold. Okay, silver, going back March, just over a year ago, we had a ratio at 126 to 1, silver to gold. It was outrageous. We contacted all of our clients, as I'm sure a lot of bullion dealerships did all around the world, and said, hey, you really need to consider silver very strongly now. This is ridiculous, 126 to 1. And we know that the ratio generally in difficult economic times, and we have a rush on precious metals, we see it close into around 35, 40 to 1, which is exactly what happened in 2007-8 through 2011, and earlier than that, 71 through to 80. Now, it's currently 68 to 1. Now, that's a pretty valid reason, or a smart reason, for owning silver versus gold. There are other reasons that silver stands up. And silver is on everyone's lips at the moment. Gold is the gleaming metal that everyone strives to own. But I'd like your impressions, Alasdair, as to the advantages that owning silver may have over gold. Would you like to share that with us?
Yes, sure, absolutely. I mean, I think one thing I would say is that if we go back to Sir Isaac Newton, he reckoned, now, he was a very clever man. He wasn't actually being too clever. He just looked at the market relationship at the time, and he set it at 15 and a half to 1, I think, was the relationship. But the problem is that if you set up a fixed relationship like that, you're going to get arbitrage, you're going to get different interests pushing it this way and that way. And broadly, at that time, it would have been true to say that silver was the money of the people, whereas gold was the money of the merchants. So, merchants dealing between London and Amsterdam would settle in gold rather than silver, for example. But silver was the common money. And indeed, sterling was it was a silver standard, actually, until 1816, even though gold had taken over to a large extent before it was suspended during the Napoleonic Wars. Now that relationship, I wouldn't really look at this stage for that relationship to return. The thing that really did for silver was in the wake of the Franco-Prussian War in about 1870-ish, Germany won, or Prussia won that one, and sought and obtained reparations from France in gold. So Germany at that stage, or Prussia, moved from a silver standard onto a gold standard. And that sort of, basically did for silver on the continent. And at that time, the gold-silver ratio rose to well over 20, even more, because, the money is such an important use for silver in those days. I mean, it wasn't used for very much else other than jewelry or plate and high-value items, if you like, sort of for the home. So it did have those special uses. It's evolved hugely since then. I mean, going through photography and everything else, solar now is so important, and so on. But what has happened really is that it's just been completely demonetized. Now, when you get a collapse of fiat currencies, which isn't, I mean, whether it's a slow event or a fast event, doesn't really matter. What happens is that people will look for substitutes for money. Now, obviously, gold is up there because central banks have gold, and the only way they can stop their monies collapsing into absolutely nothing is to reintroduce a gold standard so that, the money out there is already distributed. But, let's say in Australian dollars, it's $500,000 an ounce or something like that. I mean, I'm just sort of making up a scenario. Then under those circumstances, you will have gold substitutes, which people will, can then rely on. The losses getting there are absolutely huge for everybody. Now, in that scenario, the only way in which you can really make a new gold substitute standard work is to back it up with coins. Now, that's the important thing. So that, I mean, we've already got sovereigns over here, which are legal tender. I mean, an idiot would swap a sovereign for a pound because roughly they're worth 320 or something. So, but they are still legal tender. That's the important thing. And what I would envisage is that any country really trying to stabilize the currency situation would not just look at gold and gold coins, but also look at other forms of metallic money. And obviously leading the field is silver. You don't need to price silver at 15 to 1. You could easily price it, say, at something like 20 to 1. You wouldn't get that problem that Isaac Newton discovered in the wake of him fixing it 15 to 1, that, that gold left the country because the merchants demanded it and you only got silver. You can actually avoid that. You don't need to go on a double standard. But what we're looking at, I think, is a potential gold to silver ratio under those circumstances, perhaps of about somewhere between 15 and 25 to 1. Now, that's obviously a hell of a lot different from the 68 to 1, which is the current level. And the way I look at it in terms of market price is that silver is roughly 1.8 times, 1.8 to 2 times as volatile as gold. In general terms, sometimes, it doesn't actually move in a mechanical ratio, but that's the rough sort of ballpark. So if we see gold going up, I would expect to see the price of silver rising nearly twice as fast. And for anyone who thinks that gold is very undervalued in the monetary sense, then silver becomes the preferred metal to play that catch-up. Because if you look at both gold and silver, they are underpriced. They are underpriced because they're dominated by huge, great paper markets, which absorb all the potential demand, other than demand for people who really do insist on having physical. So there is no doubt about it that gold and silver have become very underpriced as a result. Now, if you're going to play the catch-up, then obviously silver is going to make you a lot more wealthy, if you like. I was going to say give you greater profits, but we're back to fiat currencies. Make you protect your wealth a lot better than just gold. So, and in general terms, I think the way I would look at it and the way I do things personally is at the moment, I have about 2/3 in silver and 1/3 in gold of my money. That's the way to look at it. So, I mean, I think silver's got a great future in that sense. And of course, the third money is copper, because if you go back, the history of metallic monies, copper was the third one. I mean, the lowest value. And it's interesting to see. I mean, copper has been performing incredibly well. It crossed the $10,000 a ton level this last week for the first time, I think, in over a decade. So why isn't gold going up? I mean, and why is silver stuck where it is when all these commodities are rising? I mean, it's just completely
all around them. I agree.
We ask that same question, don't we, Darryl, quite often?
Sure. Yeah. Well, we're just. Sorry, Alasdair.
I think we do know the answer, and that is that certainly when it comes to gold, the authorities do not like the idea of seeing a rival to their fiat currencies. I think they are very sensitive to that. On the one hand, they're concerned about the future of their fiat currencies, and they will include gold in their reserves because there is no counterparty risk to it. I mean, US government being a counterparty, do you want to hold dollars or do you want to hold something which doesn't have that risk? So, that I think is a very important point. But the thing that's interesting when it comes to silver and governments, they don't hold any silver, or they certainly don't hold it on the central banks. I mean, whether there is any sort of industrial stockpile. I mean, I think countries like China would run an industrial stockpile, but there's very little evidence of it. I mean, the US used to run huge stockpiles, 20 million ounces, I don't know, whatever it was. There's no evidence of that anymore. That's all been sold off so far as we're aware. So they don't really have any control over the silver price. But if silver starts suddenly shooting north, there are two problems. First of all, the bullion banks still deal in silver, and they don't like being caught short. They are not hugely short. They are a little bit short at the moment. So that's not an enormous problem, but it's the warning sign. Silver is the canary, if you like, in the gold mine, which is sort of about to keel over because there's something wrong in the system.
Yes.
And I think it's from that point of view that the establishment is not keen to see silver price rise. And of course, you've got the other thing. You've got huge, great industrial interests who want to keep the price down. So I think this is probably where China comes in too, because they're the largest manufacturers of solar panels in the world. They've been industrializing at a huge pace and are still continuing to do so. And I think they would naturally want to see silver as low as possible.
Yes. But But you can't stop it. I mean, I remember Brian and I were buying silver in 2000 at $4.50 an ounce, and it's currently $33.50. So that's a pretty good return. That's like 8 times or thereabouts over that period of time. I think it competes fairly well with any other form of investment, if we want to call it that, versus real estate, bonds, stocks, or anything else. So it hasn't done too badly, has it?
No, not a lot better, Alasdair, than money in the bank for some time now.
Oh, yes.
Very low bar there, Brian.
I will share this with you, Alasdair. I'm 80-20 silver gold. John Adams tells everybody that he said I'm 90. He says 99% silver. It's not quite true. He is 99.99% silver. He is all in. Craig Hemke, with reference to the silver squeeze, Craig Hemke is talking over the next couple of days, 100,000 people purchasing 100 ounces of silver and really cause a stir at the COMEX. And then after that, over the next couple of months, 1 million people purchasing 100 ounces of silver. Now, if we could do that, it's going to have a huge impact on the COMEX and their obligations. And they're having to source silver all around the world to cover those obligations. How do you see this? If 1 million people over the next couple of months ordered 100 ounces of silver, how do you think that would play out?
Well, I mean, there just isn't the liquidity there, I think, is the short answer. So it would certainly drive the price up and move the pricing from the paper markets back into the physical market. It would expose the fact that paper market prices are just completely wrong.
Yes.
Now, yes, I mean, whether Craig will actually manage to sort of encourage enough people to do that, we'll see. But I think even on a marginal basis, I don't think you need 1 million buying 100 ounces each. I mean, just a quarter of that, I think, would actually make quite an impact on the market. So, I mean, it's there to be done. It'll be interesting to see how successful it is. But again, I mean, what was interesting was this Reddit thing. I don't know if I got the right Robin Hood anyway. These guys who got their stimulus checks, putting it into silver in America. They caused a real panic. And so it was interesting to observe. And I think, I mean, they were buying SLV rather than, and also the Sprott one. Is it PSL? Anyway.
Yeah, PSLV.
That's it. Anyway, they were buying those two. And, that created absolute chaos. The price spiked up to $30 and all the rest of it. And it was then all hands to the pumps as the establishment tried to bang the price back down. So, I mean, I think I would very much like to see it because, the establishment stopping people from protecting themselves, which is actually what it's all about. They don't want us to do this. I think that's the point where, I really do think the establishment is doing us no favors whatsoever.
Yes.
They are actually, in a sense, doing us a favor because for people who haven't got in yet, they're keeping the price down for you. So they're keeping, they're holding the gate open, as it were.
Yes, they are.
But of course, what they're doing with that is they're trying to, tell us all that, there's no point in buying silver. It's not going up. Go and play the cryptocurrencies if you really want to play that game. Forget silver. It's not that's not going nowhere at all. So, so you've got all this disinformation, and they sort of bring out all the negatives, and people come out and say, well, the charts are looking terrible and all the rest of it, and it could only rally to 27 before it's going to go down the toilet. You got all this stuff to discourage people from actually buying and owning physical silver. Now, when the government tells you to do something, even maybe with COVID, ask yourself a question: why are they telling me this? And I think that a healthy distrust of the establishment is the only way in which we can really protect ourselves with precious metals.
Yeah, it's in our hands, isn't it?
Oh,
it is in our. I mean, I think this is what let's test them. Let's test them. We are in the driver's seat. If we get behind this, 100,000 people get behind this. And as you say, Alasdair, we may not need 1 million over the next couple of months to have a huge impact in this market. So let's test it and let's see how well these guys respond to it. But I think that what everyone's got to understand is 100 coins, 100 ounces may not seem a lot to some people, but if enough of us unite, then we can have a big impact on this market.
That's a lot of ton of silver. That's exactly right.
Yeah.
And I was just discussing with Darryl even just this morning that they are doing us a favour by keeping silver down low, because we've seen in the last 3 months that the amount of silver coming across our desk being ordered. Every person, every family can actually order silver because it's so cheap, and it shouldn't be cheap, but it is cheap. And so while it's staying down there, there's a lot more people now on a percentage basis that are coming in, buying silver, and because they're hearing all this feedback. So it's good for silver at the moment. I will continue, Alasdair. A little while ago, I was talking to you, and I said, on my morning walks, and when I do a bit of exercise program on a weekly basis, on a daily basis, weekly, but on a Saturday morning, I am really eager to listen to Alasdair Macleod interviewed by King World News, and it's a audio podcast. And while I'm walking, I'll listen to that. And Alasdair, I commend you. Every time I'm walking, I have a chuckle, and I really because you bring across certain things that are so relevant. Yeah, so relevant that for myself, I say, yeah, I've got somebody on board that thinks exactly the same. But I have a question that came across King World News, or an article at King World News just recently, and I believe you stated, that patient gold and silver bulls are going to be rewarded. Have we seen, Alasdair, have we seen the low in silver, and do you, with your calculations, see the US $50 an ounce in the near future?
Well, I don't make forecasts because as a stockbroker,
don't want you to.
many years, I know that this is it's a hostage to fortune, as it were. But there is no reason why silver should go any lower, other than manipulation by the bullion banks. But I think that bullion banks basically are running scared. They can't close their short positions in gold, which amount, on my calculations, to around about, I think, $35 billion between about 30 of them. This is serious stuff. If you've got an average loss on your books of about which sort of coming up to a reasonable fraction of that, assuming that you went short at a level and you're short of $1 billion worth, and you're probably losing, I don't know, sort of 100 or 200 million on it. This is serious stuff, and it's the only thing you can do is try and job your way out of it. So you let the price rise a bit, and then you bang it, take out the stops and all the rest, all that sort of stuff. So apart from that, it is absolutely clear to me that on any long-term basis, given the massive quantity of dollars and bank credit that have been printed, certainly since the Lehman crisis, gold and silver are as cheap as they ever have been. There will come a point where broken markets begin to fix themselves, because markets always win out in the end. I mean, central banks can suppress this, suppress that. Big banks can do this, push the price down, push the price up, whatever they want to do. But at the end of the day, and it may be sometime in the future, but at the end of the day, markets always return, if you like. Pricing comes back. Pricing gives you the right economic signals. We're not getting the right economic signals at all at the moment because of the suppression of interest rates. The amount of money that's being literally hosed into financial markets. I mean, 120 billion a month going in from the Fed into pension funds and insurance companies in the form of QE. I mean, this is just massive. This is just market rigging, complete market rigging. The markets are fundamentally broken. And part of that is the suppression of precious metals so that they don't indicate that markets are broken. That is going to change. We don't know when. We don't know what event is going to suddenly flick a switch, but it will happen. And then you will see that I think precious metals will be on a completely different price level. Now, when that happens, you're either in or you're out, because just imagine that we're moving towards that $50 price level for silver that you mentioned. We wake up one morning and find that suddenly it's $35 bid. What are you going to do? Are you going to panic in? Or are you going to say, hold on a minute, I think it's going to, don't rush. Let's just let it settle down, and then we will look at a level to buy some. But it doesn't settle down. It's 40 bid. What are you going to do now? Oh, dear, I think I've missed it. Look, I've been there myself. I know exactly what this trading situation can be like. What the hell do you do? And you end up buying it at $60 to see it drift back to 40. That's always the fear. So, and I mean, you've got exactly this psychology with Bitcoin at the moment. I mean, if you missed it at $5,000, then, and you're now at $56,000, what are you going to do? Do you believe Elon Musk and all the rest of it that is going to go to $1 million or something? When things are moving, you're either in or you're out. It really is as simple as that. So, this is what I tell everybody. I mean, if you believe my story that fiat currencies are extremely dangerous and in danger of collapsing along with financial markets because markets are broken, then you must have some insurance against that event. And that insurance is physical ownership of some gold and some silver. I mean, it's as simple as that. Bitcoin isn't going to save you under these circumstances at all. Because just think, I mean, people talk about Bitcoin being the money of the future, but just imagine a bond market running in Bitcoin. You'd have to have deeply negative interest rates because the supply is capped at 22 million, whereas, the global economy evolves, if you like, and, people's standard of living tends to improve. That's not going to happen with Bitcoin. It can happen with gold and silver because you have got mine supply. And not only that, but you've got supply from other uses. I mean, if you look at gold is the easy one to talk about. But I mean, the central banks have got about 35,000 tons of gold. So they can make, this is assuming they haven't got rid of it, which is certainly possible to a degree anyway. But I mean, they can turn their fiat currencies into gold substitutes at some level. So, that's fine. And then you've got obviously people like us who might have some gold, which was sitting there. And there's quite a lot of it. I would say that monetary and quasi-monetary gold is probably around about 80 tons of the 190 to 200,000 ton total. So you can see that if demand for gold goes up because economies demand it, the private sector demands more money, if you like, then, it's there in the form of scrap. It migrates from use as jewelry or whatever into a monetary use. And this is desperately important. You've got to have the flexibility, but the flexibility is with the people, not with governments. That is the key. That is the key to understanding it. And silver is very, very much part of that story. It really is.
Just to continue on for our audience here, $50, that was in US dollars, so we're talking around about $62, $65 Australian. On to my next point, Alasdair, thank you for the answer, because it needs to be said from many sources for it to actually sink in for me, let alone anybody else that's listening. Alasdair, we continue to hear about the everything bubble leading to an everything bust. Is printing trillions of dollars going to exacerbate this condition?
Absolutely. The sort of, it goes through phases, if you like. The first phase in terms of loss of value of the dollar will tend to be on the foreign exchanges. No, sorry, let me just backtrack. The first phase is in the prices of commodities. And it was last March 2020, it was March the 23rd, 2020, when on a Monday, which was very unusual, Jay Powell announced 120 billion of QE every month. And as well as that, there were various measures to cap the yields in corporate bond markets. So you could see that they were really doubling up on controlling the markets. The point about that 120 billion is that is fed through the banks. So you see that the bank reserves on the balance sheet, on the Fed's balance sheet, increasing. It doesn't go to the banks, it goes to the bank's customers. And the bank's customers in this case are pension funds and insurance companies. They end up swapping effectively US Treasury debt for cash. And the idea behind it is that cash is reinvested in assets which are more risky than the US Treasury debt. So a pension fund will go out and buy corporate debt, and it will also increase its allocation into equities. It is basically that 120 billion a month that is puffing up the markets. And it's not just the US. I mean, we've been doing it in this country as well. And Europe have got their own schemes. They call it different things, but it's exactly the same thing. Basically, it's just puffing up markets. In the case of, particularly in the Eurozone, they're more interested in ensuring that the price of government funding is kept as low as possible. And understand that, and you can understand why negative interest rates make sense for the ECB. And the same is also true, of course, for the Bank of Japan. So, they're being driven, if you like, by huge government deficit funding requirements. So that's the source of their bubble. And I don't know if I've said this last time, but there is a precedent for what we're seeing at the moment. 300 years ago, there was a Scottish adventurer who ended up in Paris in 1715, 16, who managed to convince the Prince Regent, who was the Duke of Orleans, that he had a scheme. And the scheme basically was that he would be able to pay off the king's debts. Now, this was terribly important because the new infant king had inherited all the debts of his father, who had spent an awful lot of money, not only on wars like the War of Spanish Succession, but also building Versailles. So, they were desperate for money. And the Prince Regent took this itinerant Scotsman in. He gave him a banking license and he set up the Banque Générale. What he wanted was a royal bank, but that came later. Anyway, it was then turned into the Banque Royale, I think in about 1719, early 1719, and he became controller of the currency. So he then acquired, in addition to this, the total import and export rights to France. This was referred to as the Mississippi venture, if you like, but it also included India and everywhere. It was the whole world, everywhere where France imported or exported to and from. He had the monopoly, but he needed to build a fleet of ships because all the all these earlier interests had were rotting hulks. So he needed to raise the money. So how did he do this? Well, he issued shares on a partly paid basis, 10% down, and in the fullness of time, you will pay another tranche and so on and so forth. Now, that was fine because this was such a successful scheme that, the shares went up on the, in its bank or the combined bank and the Mississippi venture went up, say, by 20% or something like that. But if you'd put 10% down, you had a 200% profit. And this was roaring. I mean, it really was. But of course, there came the point where in late 1719 and the beginning of 1720, where the calls on the original issued shares were coming due. So people were having to sell shares in the market in order to pay the calls. So what did John Law do? He printed money. The livre was the currency at the time, to buy up these shares and to keep the price rising. And so, I mean, this sort of went on until the merger of the two, the Banque Royale and the Mississippi Venture, which was in February 1720. I think it was actually delayed into early March, but anyway, that was the original scheme. The price went up to around about 12,000 livres. The king, under this agreement, was able to take out quite a substantial chunk of his interest in it, or rather, Prince Regent on behalf of the infant king, and that put a big strain on the whole situation. What then happened was that he couldn't really keep the thing going. Now, there's an interesting individual, a banker, an Irish-French banker called Richard Cantillon, who was operating at about that time. He had offices in Paris. And he made his first fortune by lending money to mainly the British nobility, but also some of the French, to buy shares in the Mississippi Venture. And what he did was, it was completely unprincipled. I mean, it's like your unprincipled silver guys out there. What he did was, as soon as he got the collateral, he flogged it in the market without telling the owner. So, that was his first fortune, because obviously when the thing collapsed, he went round and said, "Hoi, where's my money?" having sold all the stock. And there were big court cases in London. I mean, it was quite something. But getting back to the currency situation, Richard Cantillon worked out how to make his second fortune out of this. And it wasn't to sell short the shares in the market. It was to sell John Law's livre, which he did as much as he could in London and also in Amsterdam, which were the two main foreign exchange markets at that time. And the result of this was that from February in 1720, the peak of the price at about 12,000, it went down to around about 3,000 by September. But between those dates and certainly by September, the value of the livre in the foreign exchange markets in London and Amsterdam was a big fat zero. So that was the way to play it. Sell the currency. Now, what are we doing today? Hold on a minute. This is ringing some bells here. We're using currency to puff up financial markets. This is what QE is all about. It's all about suppressing bond yields, getting the pension funds and the insurance companies to, sort of buy other bonds at inflated prices, at increasingly inflated prices, and at the same time to put money into the equity markets. Now, the equity markets, in spite of the fact that we've had the worst pandemic in modern history, which has driven businesses to the point of bankruptcy, stock markets are at all-time highs. Why? Because we've got a John Law, repetition today, not on a French scale, but on a global scale. So do I think the currencies are going to survive this? I don't. I think, I'm a great admirer of Richard Cantillon for a number of reasons, and this is one of them. He was a top trader, I can tell you, in his day. He knew his onions. And I think we've got exactly the same situation. I mean, the parallels are so similar. There is one big difference, and that is that at the time of the Mississippi bubble and the time of also the bubble we had in London, the South Sea bubble, basically, if you lived outside London or if you lived a long way from a financial center, you couldn't participate in it. You really had to be within a coach day's ride of London or Paris, because you had to bring your bullion with you in order to deposit it with the broker so that it could be invested in South Sea shares, or, in the French case, we're looking at Mississippi. Now, remember in those days that if you got into a coach, a day's ride out of Paris, there was probably a highwayman waiting around the corner to rob you of your gold and silver. So, these bubbles happened despite the problems of getting to these financial centers. So they were very, very restricted. This has no restriction. And importantly, in terms of communications, today, it's instant. I mean, I'm talking to you in Australia. I mean, just absolutely instant. So this is very, very different from the situation in 1720. Now, this is important because it took roughly 9 months for the livre to fall to zero from that scheme of arrangement, Law's scheme of arrangement at the end of February 1720. How long will it take today? We don't know, but it's probably going to be a lot quicker once it happens, which is why, going back to the point about $50 silver, or $62.50 silver in Australian, once it starts rising, I mean, the psychology of trying to get in is going to be very, very difficult at the least. So, this, I think, could be a situation where, if you're not in when the thing blows up, then it's going to be very difficult for you to get in. So it's that parallel, I think, is desperately important to understand. What the Fed and the other central banks are doing is they are tying their currencies to the fate of wildly overvalued markets, financial markets. And that is not a good thing.
No. When you were talking, Alasdair, on the Frenchman, the Scottish gentleman that went across to Paris and started the lever, it brought me back to a comment that I think we can sum it up in a little way. It's called "Power corrupts, and absolute power corrupts absolutely." He had all the power, and when you have that sort of power, you are very much corruptible. Reminds me of the US dollar, Darryl, but I'll continue. That's all right. Now, my next question, you've really answered this, and so I'm going to make a statement rather than a question, and then I'm going to hand it over to Darryl to close, because we've learnt a lot tonight, and we need a strategy to end the broadcast with a very positive note. I read an article out of Gold, Switzerland. Matthew Piepenberg did this particular article, and he said that he was talking to Jeremy Grantham, co-founder of GMO Investment Strategies, said that the US markets are experiencing a market bubble of epic proportions. And he used the word epic and underlined it. Alan Greenspan once said, lower rates stimulate markets, and that market wealth trickles down to economic health. I feel that he's on the wrong wavelength of Alan Greenspan, who, by the way, was a federal chair for 12 years. But the bottom line is, would you agree with me? Are we in the biggest risk asset bubble in recorded history, including bonds? Maybe a short answer.
Yes, absolutely, because this is global. It's as simple as that. And I've just explained why I think that it will take currencies down with it. So, yeah, I mean, this is really, I think it's an extremely dangerous situation. I mean, I've read history of bubbles before, and I've been in some myself. I mean, the first one, when I started stockbroking, was the Australian nickel boom. And I remember that very, very well. Yeah, Poseidon and Tasmanex and all the rest of it. And I seem to remember the chairman of Tasmanex stood up one day, probably having had too much of a liquid lunch, and said a few things. And the price went up from something like, this was in London, something like, sort of 15 pounds to 40 pounds a share, just literally like that, right, before it came back. Yeah. So, no, I have had experience of bubbles and quite a few of them, but this is so widespread and so general. It's very, very hard to see how we can come out of this without so much collateral damage. I mean, I thought that the .com bubble was very much on the scale of the South Sea bubble. This one is larger.
Mm-hmm. There's nothing more I can say, Darryl. I'm going to hand it over to you.
What I'd like to just add to that, because Alasdair was just talking about, we have been talking about overvalued markets. Alasdair, it was really interesting. I was listening, watching mainstream media the other night, which is a rare occasion or a rare occurrence for me to do that. But I was listening to a gentleman who was an economist here in Australia being interviewed on a morning show. And he was asked what he thought was going to happen in the real estate industry over the next year or two. They said, well, what is the expectation for real estate over the next 12 months, this calendar year? And he said, well, property valuations are, we believe, going to increase by about 16%. Now, that's quite dramatic, 16% in a year. And they said, well, okay, so what about after that? Let's talk next year. And he said, about 6%. So he said, well, we don't expect to see this growth continue. 16% this year, next calendar year, 6%. They said, what about the following year? And he said, 0. We don't expect any growth at all. And they looked at one another in a state of shock and said, well, why would that be? And he said, well, it's pretty simple. He said, it is obviously unsustainable. He said, real wage growth is about 1% a year. And he said, these properties will become unaffordable. It's really as simple as that. If wage growth isn't growing at somewhere near the rate of that property appreciation, then they become unaffordable. And the interviewer looked at his partner in a state of shock and went on to another subject. And I think to myself, how many intelligent people are there out there at the moment that haven't worked this out? They did say something else. They asked the economist where the growth was coming from, and he said 55%, this is alarming, 55% of the growth is coming from first home buyers, which he said is unprecedented. There is no one at the moment in Australia who said the investment market is 0. It's really first home buyers. And that's all been brought about by easy money, as we all know, 0 interest rates or close enough to. You can buy a property at the moment, 2% interest or less. And the only reason people are buying properties at the moment is because they can, or they believe they can afford them. That's without any incidents taking place over the next year, 2, 3, 4. So hence the boom in real estate, easy money, low interest rates. And for first home buyers, they're collecting somewhere near a $40,000 upfront gift to get started. So obviously bound to fail. Whenever we've financed economies like this, and it's happened many times, as we all know in the past, it always ends up badly. And I can't see it happening any other way. What really concerns me is that, and you can understand this really only happens about every 100 years. And so there's hardly anybody that you and I talk to that have ever experienced this before. And so they tend to, I believe, ignore or overlook what you're saying because it's bad news and they don't want to hear it. And that even makes it worse for the overall result, doesn't it?
It closes their mind.
So just quickly, Alasdair, the real estate market, I think it's doomed. I think this economist was correct. Just quickly, what are your thoughts there?
Well, I mean, one of the problems I think is which you've touched on is the amount of borrowing that's required in order to sustain these prices. And there comes a point where, if let us say currency starts sliding, then interest rates are going to shoot up, and at that point, anyone who's got a huge amount of debt, in theory, is going to be in trouble, and that would undermine the market. But there is another way of looking at this, and that is that everybody is in the same situation. The banks and mortgage companies are not in a position to foreclose. So you just sit there, don't pay your mortgage, and just ride it out, because everybody else will be doing exactly the same thing. Now, under those circumstances, you could end up picking up the benefit of the collapse of the currency's purchasing power. Because in terms of the order of scale of things, the best thing to have is sound money, gold or silver. And then a long way under that, the next thing that's going to appreciate in price most is probably property. But in real terms, in terms of gold and silver, it'll fall very, very substantially. I mean, I've said so many times before on different shows that there's the example in Germany where in Berlin, you could have bought a 6-bedroom house in a swanky part of Berlin for $100 in late 1923. The thing is, you had to have the foreign currency to do it. And the foreign currency was convertible into gold. I mean, that was just less than 5 ounces of gold. So you can see the distance between the value of property and the value of sound money. But expressed in a collapsed local currency, a property that you would have bought, say, today for $500,000 is going to be worth, what, $20, $30, $40 million. But you've got to ride through the thing.
Yes. Yeah, exactly. Yeah. I think Jim Sinclair, I think it's about time to mention Jim. I've always been a great believer in his most famous quote, and that has been to operate as a central bank, become your own central bank. Right now, I think more than ever, this is the time to do that. Central banks own gold. Why do they own gold? To have control, to have influence, to have power, to protect their assets. We should do the same. We should become our own central banks. And I think Egon von Greyer's, we have an enormous amount of time for Egon, of course, and I continue to repeat this, but Egon, upon being asked the question, how much should I invest in precious metals? I think he's got the perfect answer. Whatever you can't afford to lose. And I think that's what, I think it's hit it right on the nose. So what I'd like to do at this point of time, of course, Alasdair, is thank you once again. And thank you. It's just terrific having you on the team and at As Good as Gold Australia. And we really look forward to the next 12 months, gaining input from you as we have over the last couple of months. It's extraordinary. And Charlie Tremendous Jones used to say, I don't know if you remember a gentleman by the name of Charlie Tremendous Jones, Alasdair, but he was a motivational extraordinaire. But he used to say, in 5 years' time, you'll be in exactly the same position as you are right now, apart from 2 things, the people you meet and the books you read. So good information. It is a really powerful quote. And I think our viewing audience tonight's got an enormous amount of value out of everything that you've said. So appreciate your input. Thank you so much. And we also would like to thank, as always, our viewing audience, our subscribers. And so until next time, if you could stay well, stay focused, goodbye for now.
Goodbye for now.